Good afternoon, ladies and gentlemen. Welcome to our special episode of Market Gurus, where you get to meet the finest brains on the Large Street, people who have made money in all sorts of environments and made their clients super rich. We are joined today by Mr. Jyotivardhan Jaipuria. He's the founder and managing director of Valentis Advisors Private Limited over the last 9 years and has spent more than a decade with Bank of America Merrill Lynch, and before that he was with ICICI Bank. Mr. Jaipuria is a fine individual with a fabulous grasp on the market and has seen about 7 bull and bear markets. Let's welcome him. Namaste Jyoti ji, a very warm welcome to you, and good to have you at the start of 2025 when the sentiment on the Lal Street is a little wobbly. How do you see it, and how does 2025 look to you?
Shell, Happy New Year to you and all the viewers. What we've seen over the last few years has been like a great return. So ultimately, we have to put it in that context that at some point it's a year where I think it's a year of consolidation. We need to absorb a lot of the returns we've got. Valuations are not cheap, as we know. And so, the valuations can reduce because markets consolidate. They don't give a great return. So valuations come down because of time correction, or they could come down with a price correction. I think this is a year where we'll probably have time correction, we'll have lower returns, and investors should temper down the return expectation relative to what we got in the last few years. We won't see a repeat of what we've had in the last few years.
Very good afternoon to you, Mr. Jaipuria. Good to have you with us, Sakshi, this side. I wanted to also ask you, every year we begin by thinking, okay, is this year going to be different from before? What strategies are going to be working this time which did not work previously? Are there going to be any newer sectors that are going to be on top of the radar? So how are you navigating through those kind of expectations here? Do you think, those sectors that have probably not made money in 2024, they will come up front, or will it be a continuation theme in 2025? What's your sense, sir?
Yes, actually. So, we've done a lot of analysis on this. So our think is, generally sectors and stocks which do well in one calendar year very rarely repeat the next calendar year. So it's not, there are some exceptions always, but in general, you have to start hunting for winners, which are at the bottom of the pile rather than at top of the pile. Secondly, is if you just look at our whole investment philosophy, we have something which we call the 3Us. And the whole 3Us philosophy is we buy, undervalued stocks which are underowned and underperforming. So, by nature, probably we end up hunting stuff which is not good. So, like if we have to just put this down to a sector and give an example, banks have not done well for 18 months now. And, nobody likes the banks. Banks are doing badly. But if you look at sheer valuation, so banks is one of the only sectors which actually trades today at a valuation which is lower than the 10-year average valuation. So we do 10-year average for all the sectors, whether we take PE or whether we take price to book, which we tend to take for banks. Banks are trading at valuations which are lower than the 10-year average. It's a sector which has underperformed massively. There's very low expectation on it. Most of the expectations are negative. So over the course of the year, we think is the sector will do well. It doesn't mean it will do well from this month itself, but it's a sector which we have started nibbling into, and we think that's a sector which will probably play out well for us over the course of the year. Uh, partly the way we are thinking is this is the year to play probably a test match and not a T20. We played T20 for the last few years. We have to play a test match. We have to again learn how to defend, with sometimes, Indian cricket team also forgot, I guess, when they were playing tests. So it's a year where you don't have to do anything stupid. In fact, we would be very cautious on some of the sectors which have done well over the last couple of years, where valuations are very, very expensive, and a lot of future earnings are probably built into the stock price.
Mr. Jaipuria, that's a very hard example to take, that the Indian cricket team, and we've also lost ground for the last 4 months or so in the markets, and perhaps defense is the best offense. This is what we've often seen. Please tell us about your funds. You manage about 1700 crores over 2 funds. What is the cash component on both funds? One is a multi-cap, the other is Rising Star.
Rising Star,
And
yeah.
any reason why you have cash at the moment?
We have cash and we slowly built it over the last few months because for us, the valuations were looking expensive. Now, when you build the cash, the whole idea to build cash is primarily two. One is valuation are looking expensive, so you want to take some money off the table and wait till you get valuations coming to better levels and you want to buy. Second is, there's a lot of global uncertainty at the moment in the world on the policy framework because we have probably, the Trump administration, which technically gets sworn in on 20th of Jan. And, there have been a series of tweets from him and no one really knows what is the sort of policy he'll come with. My view is, typically politicians say a lot before they come to power. When they come to power, they don't do anything as dramatic as they make it out to be. But still, you want to be a little cautious because you don't want to, have zero money if markets come down. You want to be able to buy at lower levels. So for us, it is we'll get a chance to buy. Markets will be more volatile than what we've seen over the last 3 years because last few years were just markets going up one way, every 1%, 2% drop was like a buying opportunity. And that is not normal. Like if you see markets over the last 25 years, 22 of those 25 years have led to a correction of at least 10% in every calendar year. So it's like we are holding cash at the moment now just to see if we can buy some things cheaper because valuations are not too easy to buy at the current stage.
Okay, got that. First up, I'll also want to understand from you what's your own expectation on the upcoming Q3 earnings. We are just right around the corner, especially from the large cap IT space. What's the expectation there? And overall, what is your understanding of how Q3 could pan out? Q2 was a big disappointment. Do you think that could continue even in Q3?
Actually, I think Q3 will be little better. So that's the good news. But I think it will only be a little better. So it's not going to be a spectacular season. But maybe it's like, I look at it as okay, the downside has got capped and we start moving up the curve a bit. I think Q4 will be better than what we've seen in Q1, Q2, and Q3. So Q2 was bad. Q1 actually was the first time where we saw bad numbers, but probably the market was going up, so at that time people were not paying as much attention to it. We were trying to flag it to everybody that results are not looking great. I think Q3 is going to be like, after having on the broad Nifty, you probably had a negative sort of earnings growth or just about flat. We think we'll have like a single digit growth, which probably will be mid single digit growth for the Nifty for this quarter. And probably the next quarter, which is the March quarter, will do better and we'll probably end up with double digit growth for the Nifty there. Now, two reasons or three reasons why we think things will improve. One is, the government spending. So government just didn't spend in the first half of the year, partly because of elections and a lot of the uncertainty surrounding it. We have a lot of budget, especially on the capital expenditure side, which they have to spend. And there are some signs they're spending more than what they did in the first half of the year, but it's still not what I would say is fully what you need to do to meet your budgeted capital expenditure. So I think, third quarter will see that benefit of better capital expenditure happening from the government. Probably fourth quarter will be where they'll go full throttle and spend a lot of money. The other is the monsoon, and the monsoon has been good. Crop has been good. So farmers will start getting benefit of that income flowing through, which will largely be felt in the March quarter, but to some extent is felt a bit in the December quarter also. Third is we've seen, RBI help on the liquidity front because, the 50 basis CRR point cut was probably more than what the market was expecting. So you have that 1 lakh odd crores which will flow into liquidity in the system, which also somewhere helps the demand process. So I think overall Q3 will be okayish type of quarter. Probably the good news is a little better than the September quarter. But I think Q4 is where we'll probably see a much better pickup coming.
Right. Mr. Jaipuria, despite 2024 giving about 23-24% return on both the small cap and the mid caps, investors are largely disappointed because last 3 months saw a very sharp erosion in prices for these outperforming assets. You yourself have a huge weightage of smalls and mids in the multi-cap portfolio as also rising stars. How do you see this universe? What are the pockets of outperformance you expect in 2025 and where do you see pain?
So, Shailesh, if you rewind the clock a year ago, go into January of 2024, the very broad consensus was that the small cap, mid cap will underperform the large cap. Large cap will do better than the small and mid cap. And what actually transpired was the opposite of what the broad consensus was, which is like, the small cap did way better than the mid cap did way better than what the large cap did. So it's going to be a tough year. It's not going to be easier either for the small cap or the large cap because a lot of money has got made. Valuations are not cheap. So to that extent, we probably are tempering down our return expectations for this year. So I would be thinking we probably may end up on a broad index level at single digit sort of return for this year, both for the small cap, large cap, as well as for the mid cap. I think the critical thing for the small cap and mid cap universe is going to be the recovery in the economy and recovery in earnings because they are much more vulnerable or they are much more attuned to what the earnings do. When earnings cycle is picking up, they do much better than what the large cap do. But when the earnings cycle is going down, they tend to do much worse than what the large cap do. So to that extent, I think the focus should be on the earnings cycle. Valuations are not cheap for them. So I think, if we get the earnings coming, then we'll probably see some valuation compression happen because, the earnings will grow at a faster pace than what the stock prices go up in F25. And so, you'll probably get a single digit return, whereas, the earnings go up by maybe, 15 to 20%. And so you can make money. Now, this is what I'm saying on the broad index. Now, of course, for, people like us or anybody who's doing active management in the small cap, mid cap space, we keep hunting for the ideas. And, the universe is quite large, right? Especially if you think of the small cap, you probably have 800 stocks you can look at. So in that, you have to go and find some ideas which generate the alpha. So even if the index can't do enough, you still, probably can find some alpha and ideas which are quite compelling. And that's what our job really gets down to. It gets a tougher job because, you don't have that much beta helping you, but then you have to create alpha, and that's what we really should be paid for.
Okay. Mr. Jaipuria, I wanted to understand from you specific pockets now, especially when it comes to the new age tech space that has been pretty much buzzing all through 2024. What is the approach going to be here? How are you going to be identifying the key stocks that one should continue to stay invested in, continue to build up further positions, or identify newer ones that are coming in from the IPO space? How are you really looking at this one?
Yeah, so, this is like a sector which, if you just think like 5 years, 10 years, the sector will be much bigger than where it is today. There'll be few players which will be much, much bigger, but there are many other players which will probably wind up. And because, it's a sector and it's a segment where the few players end up taking a large market share and a lot of others tend to really pack up. We've not been like invested in a big way in these sectors because, when we think of our three use framework and all, we look for stocks which are decisively undervalued. A lot of these are not very cheap. They are never because there are hardly any earnings over there. So we always struggle with a lot of these ideas. Unless there's a lot of pain in them, then you tend to get some of this stuff cheaper. So it will be, some of the winners of the last year, probably in terms of earnings delivery, will continue to do well because they're gaining market share. But if we get into a funding summer where, funding gets difficult and a lot of these businesses make losses. So the whole thing works on, okay, I'm making losses, but somebody's going to fund me, so I don't need to worry about the losses. Then these businesses get into problem, they get into pain. And that is where people like us probably tend to buy these things, where there's a lot of pain on the balance sheet, there's pain in the stock price.
Mr. Jaipuria, it's IT and pharma that's saved the blushes for the Nifty over the last 3 months or so, and fortunately accompanied by a severely sharp depression in the rupee. How do you see these two sectors within both Rising Star and Multicap? Are there any pharma and IT picks which you have added recently?
So there are, but if I look at the two, relatively we are more overweight on pharma than on IT. And pharma for us is like, we were trying to do analysis. So we run the fund now for 8.5 years. The single sector which has added the most alpha has been pharma for us. So it's a sector which we like and which we have done well with. We've identified a lot of winners early. So there are two things which we look for, or where we are generally placed in pharma, because within pharma there are lots of baskets which you could look at. So one is we are quite bullish on the US generic space in pharma. So, that is a space where there was a lot of bleeding going on because generic prices kept coming down. So our call is that generic prices are more or less bottomed out. From here, the decline will be very, very slow. And the stocks are not factoring in the sort of improvement we'll see in the US generic space. So to that extent, we've been buying these. To some extent, now the market consensus is also moving there. But even then, we get a lot of stocks which are fairly valued and which we think we like. The other space we are quite bullish on, and this I think is like a 5-year, 10-year story, the CDMO space. Basically, the CRAM CDMO, just clubbing all of them together. So essentially, and this is even assuming the Biosecure Act doesn't come. If that comes, then this will help the sector much more. But otherwise, this is a space where growth will be very high in these companies. The valuations are a bit of struggle. They are no longer very, very cheap because sector which has done very well in terms of stock price. But the growth over there is quite phenomenal. And so the growth will drive, earnings as well as the stock prices for you. So that's the other space that we are very bullish on within the pharma pack. IT is something which we like, but IT is something which, one of the longer term worries for me is what happens when AI becomes more and more mainstream, because it may mean that the number of jobs required start to come down. And so growth is going to be a big question mark for a lot of the Indian IT companies. And so that is where, it's like what sort of valuation do you pay for something where future growth is going to be a question mark?
Okay. Mr. Jaipuria, are there any spaces that you believe still a lot of caution needs to be warranted from investors' side? Where is it that you still believe a lot will be at stake, especially in a year where you yourself pointed out that the moderation is something that we need to keep in mind when it comes to the overall market's expectations on returns?
Yeah, so, Sakshi, without like, very generally, I'll say whatever has been the big fad over the last 12, 18 months, those are the things you need to be careful about, because valuation, they end up factoring something which is a blue sky scenario, let's say, for want of a better word. And a lot of time the delivery takes a long time to come. So it's not like the sector not going to grow,
Yeah.
but if you're trying to, value some 28 earnings and 29 earnings in today's valuation, and there's a lot of slip and luck, many a slip between the cup and the lip, and the earnings may
True.
not come. So there are sectors like this which are not poised for, maybe any disappointment. So for us, we are always thinking of what is the margin of safety for us. And investors don't have to look too far. So, like if you just think of some of these very highly valued but very good companies, very high ROEs, low debt, these were the flavors of the market for a few years. But anyone who bought them at that peak is still struggling to make money in a market which has done very well. So don't get caught into flavors of the season. It's good if you are very early into it. But if the valuations are very high, then be careful, because at some point the high valuations come to bite you.
Yes, I think growth at any price has now dented very badly over the last 1 or 2 years. But growth at reasonable price is what Mr. Jaipuria follows for decades that I have met him. Mr. Jaipuria, we are now 19 sessions away from the budget on February 1st. What are your expectations from Finance Minister Nirmala Sitharaman? Uh, in the last 6 odd months or so, there has been a huge disconnect between the market and the finance ministry. While nobody voices his or her disappointment publicly, but it's mutually known to both parties that both are angry with each other. Against that backdrop, what is your expectations from the forthcoming budget?
So, Shell, for me, like there may be some tax tinkering and all, which is always good, and that's what creates the headlines on the budget day. But that is not the most critical element. It all helps, and that day we all feel happy that okay, some income tax level was raised from X to Y, so we save some amount of tax. So ultimately, it is one is hopefully the finance ministry has to accept that there is a growth slowdown, so they need to do something about the growth slowdown. And at the same time, they can't, just blow up the fiscal deficit. They need to bring down the fiscal deficit. The good news is tax collections are still fairly, decent. So they don't have to worry about tax collection falling. And, the last few years, the budget has been very conservative. So, unlike the past, we've actually kept meeting our uh, revenue expectations every time we've done it. So I would be looking for them to, do this nice balancing where they continue to give a growth impulse. So, don't cut down your capex totally, continue to have, growth in your capex outlay, and, try and direct some of these public work programs or subsidy programs in such a way that they are income generating and they are probably employment generating. The second is try and think on can you do, because when the government came right at probably, 10 years ago, they had this whole thing that, we don't want to be governing a lot of companies. So there's this whole thrust on divestment and privatization, which has not been followed through. So maybe if they can really come with some package on we do privatization, that's the way we fund the growth to ensure that we continue the growth impulse, because it will be a period where the growth globally is going to slow down. So you have to, fight that global slowdown. India is also slowing down, so government needs to do some thrust over there. Third is this whole simplification of taxation somewhere, keeps getting left on the way because we keep adding more and more of the bureaucracy. So I think there was this whole income tax simplification they've spoken about. I don't know, but just looking at what some of the press statements have been, it's probably not coming in this budget. Other that would have been one hallmark, that can we actually just simplify this income tax to make it simple, and very easy to understand, and we probably don't need CS to really file a return. But I think the general thrust is going to be keep cutting all the sections of 80 A, B, C, whatever we have, which enable us to reduce tax by investing somewhere, and keep reducing the tax rate. So you make it very simple where you say, okay, you earn 100, you pay 25 of tax and go home, and there's no way to really save too much of taxation. But at the same time, your tax rates are coming down. So I'm hoping that gets done, but maybe that will get deferred to the next budget if they're not ready with the Simplified Income Tax Act. Now, the last thing with the market we'll be looking for is, in the last budget, we had a capital gain increase, right? Both on the short term as well as the long term. Do they continue with that, or do they say, okay, this is frozen and we are not going to again tinker with it? Market could be more disappointed this time if there's another increase coming, because then it means that there's no end. There'll be an increase next year also. But if there's no increase, then probably, that will be a good scenario. I don't think we're going to get cut anyway, any of these things.
Okay. Mr. Jaipuria, I'll also understand from you, as far as the FII flows are concerned, they've been pretty much absent this entire year, at least in the secondary market, so to speak. What's the sense that you're getting for 2025? Do you see brighter prospects for them to come back to India, or do you still see there is a lot more at hand for them to choose from, and therefore again we will be looking at dwindling flows from there?
Yeah, so actually, one thing you already mentioned when you said this, they're not as negative as they appear, because there was a lot of money which was going to the primary market. So when you add up the, they're not as negative as they appear. But the second thing is, there are two things which are hurting our flow. First is the money moving from emerging market to developed market. And that's a phenomenon we've seen over the last 2 months, partly because Trump has come in. He's talking of very, very pro-growth measures. Like, if you still hear his statements, his thing is, I want to bring down corporate tax rates to 15%, which, for a developed country like US will be phenomenal. So, you'll see that shift. The other is, if you look at the dollar, so every time there's a dollar strengthening, flows tend to go to the developed market away from emerging market. Every time the dollar weakens, then we see that. And there's been a sharp dollar strengthening we've seen over the last 8-10 weeks. So one is there are flow which are going to the US, and that flow will partly depend on what US does with its policy. If they're very pro-growth policy, the whole thing maybe what I call the home country bias, that let's keep our money here. Why do we want to go to emerging markets? Second is, within emerging markets, our problem has been that we are very, very expensive relative to most of the countries. So, we trade at roughly 20 times 1 year forward. The emerging market basket trades at around 12 times 1 year forward. And that's the reason for most of the FIs and foreigners I speak to. They're very bullish on India over a 5 year perspective, but they say we'll rather wait for a better time where relative valuations sound more attractive. So I think, we'll probably have a better time than we had last year, partly because I think, maybe the IPO market will start to slow down once the market, does not give that same frenzy. And so that much will flow to the secondary market. And hopefully at some point our valuations start looking a little better if we continue to having growth. But at the same time, wouldn't bank on FI being a big savior for the market, at least over the next few months.
Mr. Jaipuria, what is your stand on interest rates? We were supposed to have a cut in February. Are you looking forward to it? In the meantime, there has been a change in guard at Mint Street, but we are also fighting raging inflation. We are also fighting a depreciating rupee. Do you think rate cuts are out of the window?
So I think, even globally, so if you think of where the Fed was on the rate cut and where we are going now, there's also the expectation of rate cuts are getting more and more tamed down. And in fact, my worry is like nobody's talking of rate increases today. So hopefully at some point by the end of next year, we don't start talking of rate increases. So I think, for RBI, they'll have some data points before the meeting. So one is, whether Trump really goes ahead with some tariff increases. Because if they do that, then you start having inflationary pressure building all over the world. And that, will impact them. That also impacts the second thing which you mentioned, which is the currency. So, just the currency, depreciating is putting pressure on inflation. It's basically raising inflationary expectation. And if we get any tariff increases coming through, let's say, Trump puts tariffs on China, my view is that they'll go and depreciate the currency, which means India will have to depreciate currency more. So if that starts happening, then I think at least the February rate cut then, goes out of the window. But probably my guess is if some of these things don't, become adverse, then at least they'll start debating the rate cut. Maybe they'll not do it in February, but they'll say we are starting to tilt a bit more towards the rate cut. But, the other thing which they did last time when they didn't do the rate cut is they got liquidity in the system. So that is something which is very important to keep an eye on, because once they got liquidity in the system, you've seen some reduction in bond yields anyway happening. So whether the RBI cuts rates or not, the bond yields come down, that is useful. Whereas if you think of the US, they are having the reverse situation where after the rate cut, bond yields have actually moved up over there. So there's been, some interest rate increase, even though the Fed is not, really hiking interest rate.
Right, sir. It's a pleasure listening to you, and the last half an hour has been very illuminating. I will remember this defense of 2025 in relation to how the Indian cricket team has performed and how the markets are likely to be for the rest of the calendar year. Thank you so much, Mr. Jaipuria. It was such a pleasure to listen to you, and let's hope 2025 turns out better than 2024 on the mid caps and the small caps as well. Thank you so much for your time, sir.
Thanks a lot, Shell. Thanks, Sakshi. Bye.
Thank you so much.
That, ladies and gentlemen, was Mr. Jyotivardhan Jaipuria, founder and managing director at Valentis Stock Advisors. He runs two funds, an AUM of about 1700 crores, and is playing 2025 defensively. I hope you enjoyed the conversation with him as much as Sakshi and I did. And please remain glued to Business Today Television. There's a lot happening on the other side of the break, and Sakshi and I will be back at 2:30 for the last 1 hour on markets. Thank you for watching. Let's get Vineet into the conversation in the pharma space. No let up in rallies in mid-cap pharma, and of course it's the top pharma stocks that led this wonderful uptick over the last